So let's talk about that more. Bank of America say this about the ECB. They're calling for accelerated tapering with QE ending in July, rate hikes in September and December. They say the Hawks have won. January inflation lifts our 22 forecast to 4.4%, but 23 stays below 2. They say when fundamentals aren't there, hikes can't go far. Collin Martin, can I get your view on this? This is a conversation about the start. Let's talk about the destination. How far the Fed can go, how far the ECB can take things.
That's the big question that we're looking at, John. From the Fed's standpoint, unfortunately, the markets don't believe they can get too far. If you look at expectations for the terminal rate, where we look at the Fed funds rate or Eurodollars futures a few years out, they're still stuck in that 2 to 2.25% range. And unfortunately, we didn't even really see much of a rise over the past few weeks, despite still high inflation and despite such a strong jobs report on Friday. There are some good news out there, though. One thing that we're looking at is the participation rate. We saw a good jump both in the broad index and in the prime age population participation rate on Friday. That means there is more of a runway for the economy to continue to grow, for workers to rejoin the workforce, might reduce some of the pressure on wage prices we're seeing, and that will allow the Fed to maybe hike more than the markets are anticipating. We're not, changing our tune just yet. For now, it looks like they might only be able to get to that 2.25% range, but it comes down to a balancing act. If they can successfully hike rates without, popping any sort of asset class price appreciation that's out there, without disrupting the markets too much, if they can do it in a somewhat methodical way, in a somewhat patient approach, and they can maybe get above that 2.25% range, which can lift all yields a little bit higher.
Let's just sit on that graphic that we just put up on the screen of the estimates for Thursday for CPI in America. 7.3 is the median, 7 is the low, the high is 7.6. And let's bring in Michael McKee. Mike McKee, this whole street expects a 7 handle this Thursday.
Oh, they expect a little bit more than that. And maybe we get the same thing in February. But then economists think we're going to start to go down because of base effects. But here's what we're expecting Thursday, at least the medians for what we're expecting. And it is, as you say, 7.3% for the headline. For the core, it is 5.9%. And we continue to make those 1980s numbers over again. Where does it matter? Well, it does matter down in Washington. It does matter to Joe Biden and the administration. Bloomberg, a story today about how they're retooling their economic message, because what's happening is people's wages are not rising as fast as inflation, and we will get that data on Thursday as well. The inflation adjusted wage levels, as you can see, below zero, down about 2%, and that will take a bigger hit on Thursday when we get numbers like 7.3%. So there's a political implication, but so far it is not feeding over into the economic implication. A lot of lines on this chart, but basically there are 3 break-evens, 2-year, 5-year, and 10-year for investors, and there's 2 for consumers, the 1-year and 10-year Michigan numbers. And as you can see, inflation has continued to go up, but except for 1-year inflation expectations by consumers, expectations stay anchored. So the Fed isn't going to be thinking it needs to do a huge whole lot yet at this point. So we'll see what the market reaction is on Thursday. But if we don't see those numbers, those lines start to go higher, then the Fed probably stays on course for 25 basis points and a couple, maybe 4 or 5 rate increases this year if inflation doesn't start to go back down.